Hello students, welcome to commerce classes, and today we are starting with second unit of financial accounting, which is inventory valuation. This unit has two parts. One is depreciation accounting and another is inventory valuation. So we are starting with inventory valuation first, then we will take up depreciation accounting. The basic objective of this chapter is to understand inventory, its meaning, its types, its need and significance of its valuation. Why do we actually need to value inventories from time to time? What are the basic systems that are there for the measurement of inventories and the methods of valuation of inventories? And of course, relevant standard, which in this case is AS2. So once we are through this chapter, you will be in a position to understand what exactly we mean by inventories, what are its types for different types of concerns, why is there a need to hold inventories, and why is it important to value the inventories properly. Then for the valuation purposes, what are the basic inventory recording systems and valuation methods, of course with the standards. So based on the objectives, the contents of this chapter are divided as inventory, its meaning and significance, inventory valuation, significance and components, inventory record system, periodic and perpetual. Then we have methods of inventory valuation, FIFO, LIFO and weighted average. Then you have adjustment in the inventory valuation. Like in the fourth part, that is methods of inventory valuation, we will be studying how to value the inventories. Now within the valuation procedure, how to make adjust for these special transactions, that is normal and abnormal losses of stocks or purchase or sales returns. So that will also be covered up in this chapter. And then we have accounting standard. Now out of all these units, we will be covering up these two units in today's class. So starting with the first part, that is inventory, meaning and significance. Now before we take up the relevant slide, let us first understand inventories. Now what do you think what is an inventory for a business? Like in 11th and 12th standard, you have gone through the term inventory. You have seen this in trading and P&L account. You have opening stock, closing stock. Now the term stock is also called inventory. So basically inventory means stock. But what type of stock? Stock of which item? Now in case of a business concern, inventory is the stock of those items which are in the continuous process of purchase and sale. That is the things which you buy and then you sell on a regular basis to make profit is referred as goods, and their stock at a particular point of time is referred as inventory or stock. So you are having goods or the things which you continuously buy and sell. So maybe for a stationery shop, all the items of stationery are their goods, and their stocks on a given point of time will be referred as inventories of goods. Then all the other things that they are having, like they might be having furniture, they are having shop. So all these things will be referred as their assets. Similarly, for a furniture selling unit, the things furniture will be referred as their goods, and their stock at a given point of time will be referred as inventory. So inventory means stock of the goods. The term goods is specific to a business. So different businesses might be having different types of goods. Now we are talking about right now about the purchase and sale of goods on a regular basis. But we may have a manufacturing concern also, wherein they will be buying raw materials, they will be converting them into finished products through some processes, and then they will be selling those finished products. So inventory in that case will imply stocks of all the items which go into the process of production and which are a part of finished goods. So the raw materials and other spares and stores which they use in the production process, they are all included in the inventory. So work in progress, and finally the stocks of finished goods. So all these things will be included in the inventories. So according to AS2, inventories have been defined as the assets held for sale in the ordinary course of business and in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process. So if you have a manufacturing concern for making garments, then all the raw materials in the form of clothing material, buttons, right? So all these things will be a part of your inventories. So basically, for two different type of concerns, that is trading and manufacturing concern, the inventory term will include different things. For trading concern, it is the inventory of goods purchased and held for resale. For a manufacturing concern, it will include inventories of finished products, work in progress, and materials and supplies and consumables and tools also, which are to be used in the production process or in the rendering of services. Now question arises, why is there a need to hold inventories? Why are they important for a business? Can you think of a business which doesn't hold inventories? Suppose you are selling stationery items. So can you operate your shop without stationery? Just think it over, pause for a minute, okay, and think it over. And you yourself will realize the need or importance of holding inventories. Basically, you see, in case of inventories, there is a time lag between purchase and sale or processing time lag. You buy items at one point of time, then you sell them over a period of time. So, there is a time gap between you purchase the things and the actual time when you sell it off. So if a customer comes to you and at that time if you go to buy the things, you will lose your customer. You need to keep the stocks with you to retain your customers. Secondly, your current assets are having a very important component, that is inventory. It is the largest component of current assets which affect the liquidity, because in a business, regular liquidity, that is cash, it comes through the sale of goods, and if you are holding inventories properly, then only you will be able to make sales happen, isn't it? So they affect the liquidity. It's a major asset affecting operating efficiency. Efficiency herein implies the profitability. So in case you are not keeping inventories, you won't be in a position to make sales, right? So your profitability will also be affected. So your operating efficiency is affected by inventories and their value. Now, in case of inventories, we can say that both its excess as well as a shortage will be affecting operating efficiency as well as profitability. Reason being, if you hold more of the inventories, of course, you will be able to satisfy the customer whenever the customer comes in. But the point is, by holding more inventories, you will be taking a lot of time to clear your stocks. So your stocks will become outdated and you might not be in a position to fetch good price. Along with this, you will have to incur more expenses on their storage. So excess of inventories is not good. On the other hand, shortage of inventories is also not right, because if you are not holding inventories up to the right value, in that case, you may be losing customers whenever they come. You might not be having proper inventories with you, so you will not be getting business. And that is why we say that both excess and shortage of inventories will be affecting our operating efficiency and profitability. So you need to hold appropriate amount of inventories, and in order to hold it properly, we need to value the inventories properly. Because if the valuation method is not correct, then your further calculations based on that might be the liquidity, that might be the say estimates about profitability, all these things will go haywire. So you need to hold them properly and you need to value them properly. Unwise investment in the inventories as well as improper valuation will affect liquidity and it will affect cash flow management. Of course, if you are not holding inventories properly or the valuation method is incorrect, it will affect your liquidity and it will affect your further decisions relating to cash. For example, say you are having inventories shown in the books at say 1 lakh rupees and you know that you sell them at 20% more. It means you are likely to get 1,20,000 in a given time. Say your turnover period is 2 months. It means you are going to realize 1,20,000 within 2 months. But if say the valuation technique is incorrect, suppose you have overvalued them, your actual inventory is much lesser. Now you are expecting 1,20,000. Accordingly, you manage your cash. You might be say you are to buy some asset in the future. So you have some estimated cash availability. So you are right now you are in a safe position that we'll be getting the cash and we'll use it to buy the asset. But if your calculations are based on wrong valuation, then all your calculations and their decisions will be incorrect. So that will affect your business. So we need to hold them properly and we need to value them properly. So what is the significance of inventory valuation? A part of it I have already explained to you, but let us study it further. Number one is inventories affect the liquidity. Liquidity here means cash availability. So if you are not valuing your inventories properly, your calculations or estimates of cash will be incorrect and your decision making based on that will also be incorrect. Maybe you are to pay off a loan and you are relying on the inventory values. That this is our inventory, we'll fetch this much cash and we'll be in a position to pay off the loan. But if your inventory valuation is incorrect, it implies you won't be getting that much of cash. So it will affect your business. Another is it has an effect on profitability. Now when we talk about inventory valuation, usually it is the valuation at the end of the year, because the inventory at the end of the year is carried forward to the next year. So your opening entry is nothing but the closing inventory of last year. So when we value the inventory properly, then only our income statement will be showing correct information. So if your inventory valuation is incorrect, it will affect the profitability. Let us explore this profitability aspect a little further. So what is the profitability? Profitability affects on the valuation of, it depends on the valuation of inventories. Like if we say opening inventories. Now if you overvalue these inventories, then it will be resulting in lesser profits and more of cost of goods sold. Now how this happens, let us explore it further. Now you see cost of goods sold is opening stock plus purchases minus closing stock. Now what it means is that your cost of goods sold is directly associated with opening stock, isn't it? If your opening stock is overvalued, your cost of goods sold will also be overvalued. So increase in opening stock or overstatement of opening stock will lead to overstatement of cost of goods sold, and since it is negatively related with profits, so it will lead to lesser profits. On the other hand, if your opening stock is undervalued, cost of goods sold will be undervalued and your profit will be higher in that case. And if we take up the closing stock valuations, then the relationship is reverse. Closing stock is negatively associated with cost of goods sold. You can see here, okay, it has a negative relation with the cost of goods sold. Whereas when we talk about profits, closing stock has a direct association. More of closing stock, more will be the profit shown. Less of closing stock, less will be the profit shown. So what we can say here is that your valuation of inventories will be affecting your profits as well as your cost of goods sold. All right. So opening inventories, if they are overvalued, it will be resulting in overstatement of cost of goods sold and understatement of profits. Whereas their undervaluation of opening inventories will be leading to understatement of cost of goods sold and overstatement of profits, because opening inventories are directly related with cost of goods sold. But when we talk about closing inventories, relationship is reverse. Closing inventories are indirectly or negatively related to cost of goods sold. So higher the valuation of closing inventories, lesser will be the cost of goods sold and more profit will be there. So this is very important to understand that inventories should be valued properly if we want to show income properly. Okay, then it has an effect on the financial position. Reason being, in our balance sheet we are showing fixed assets, current assets, and in current assets inventories is a major part, sometimes as high as 75% of your current assets are in the form of inventories. So if you are not valuing your inventories properly, it means your balance sheet is not reflecting the assets in a true and fair manner, and all your calculations or further analysis based on these figures will be incorrect. Your current ratio, liquidity ratio, stock turnover, so all these things will be incorrect and it will lead you to misleading decisions. Finally, to comply with the rules and standards, we need to value inventories properly. Now, let us see what are the components of inventory valuation. Now, consider you are, say, in charge of a business selling, say, chairs. We are just taking a simple example to understand the valuation. Now, if I ask you what is the value of chairs available to you on a given point of time, say right now. Now, how will you measure inventory value? You will first be counting all the chairs or inventories with you. Then you will be multiplying that with its price, that is cost price. That will give you the inventory value. Right now we are saying cost price, but we'll explore it further. So value of inventories is quantity at a given point of time into price. Inventory, remember, is a point measurement. You value inventories at a given point of time. It's not a flow thing, right? If you want to know stock, then it is on a given point of time. So you need to measure quantity, you need to multiply it with the price. Now, what is the price here? Now, as per accounting standard 2, price will be cost or market price, whichever is least. So there are two components here, quantity and price. Quantity is of course measurable in terms of units, kilogram, liter, etc., depending upon the nature of inventories. And the term price here means cost or net realizable value, whichever is least. So we take up LCM rule that you might have studied, that inventories should be measured at lower of cost or market price, but the term market price is replaced with net realizable value. Basically, the concept of net realizable value is that in order to make the sale happen, we need to incur some expenses. So these are directly associated with the sale. So we should consider net realizable value and not the selling price. So if say you are selling a particular item at 100 rupees, but in order to make that sale happen, you pay 5% commission to the salesman. Okay, so your net realizable value will be 95%. So if the selling price is 100, your realizable value is 95, because in order to make that sale of 100, you need to pay 5 rupees. Okay, so the inventories will be valued at cost or market price. That is net realizable value, which is least, and it is based on the principle of conservatism. That is, in no way we are to add holding profits. Okay, so these are two components. Now, when we talk about the measurement of the quantity, there is a system of inventory measurement. You might have periodic system or perpetual system. So under both the systems, inventory's quantity is measured, then it is multiplied with the price. Now when we talk about the price, again we have different type of prices. Even when we talk about, say, cost, we might not be having one figure of cost in a year. We might be having a whole flow of costs. Like initially, the price may be, say, 10 rupees per unit. Then after some time, there is a change in the price. And over the year, during the year, the price might be increasing or decreasing many a times. So when we talk about the price, again, we have different methods how to price the inventories. So we'll be studying these two, that is inventory record system and inventory valuation methods, in the coming classes. Now, let us take up these two components in detail again. The cost of inventories shall comprise of all cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. That is, if you incur any cost to bring the inventories to the place where you are going to make the sale happen and in the form in which you can sell them, then all these costs will be a part of cost of inventories. So this will include all type of inward cost, like you might be paying some kind of, say, octroi taxes, or you might be paying loading charges, so to bring the inventories into the business. So these will be a part of your cost of inventories. Then cost of conversion, you might be buying raw materials, then you are incurring some cost to convert them into finished product. So this cost will be a part of cost of inventory. Maybe you are incurring some expenses on their packaging. Okay, so to keep them safe. this will also be a part of cost of inventory. So cost of inventory implies, basically, as the term says, in bringing the inventories to their present location and condition. That is, right from scratch, whatever amount you pay to bring the inventories up to the place of business and in the form in which you can make the sale. All the cost that you have incurred up to this stage will be your direct cost, that is cost directly associated with inventories. But beyond that, once you have brought them into the form in which you can sell them and to the place, then beyond this, if any cost is incurred, it is not included in the cost. So the term cost excludes abnormal waste of materials, labor cost, etc., storage cost, administrative cost, selling and marketing costs, and where inventory is purchased on deferred terms, then any kind of interest, etc., paid over time. So these costs are incurred later on. So these are not relating to bringing the inventory in the form of sale or in the place of sale. So these costs are excluded. Net realizable value is basically net selling price that concern expects to realize from sale of inventories, less estimated cost of completion and cost of sale. Right. So this is what I explained to you there also in the previous slide, that net realizable value is the net amount that you are expecting to realize from the sale of assets. So any cost of sale which is directly associated with sale or any cost of completion, that will be excluded therefrom. Like you might be selling, say, computers, and in order to make the sale happen, if your customer says that you will have to, say, install this software in this, so in order to make that sale happen, you are incurring some cost. So that cost of installing the software, that will now be a part of cost of completion. So that will be excluded from the selling price to find out net realizable value. So the least of the two is taken as the cost of the, or the price of the inventories. So inventories are priced according to different methods, because in a particular year we might be having a whole flow of costs. So what are the basic techniques of inventory measurement and their valuation, that we'll be taking up next time. So I hope up to this you are clear about the first two parts of this chapter, that is, what is inventory, why is it important to hold the inventories, secondly, what is inventory valuation, and what is its significance and its components. So next time we'll be taking up inventory measurement systems. Thank you.